As tech companies' AI-related spending has ballooned into the hundreds of billions of dollars, one of, if not the big questions has been about revenue. In other words, when should we expect these investments to finally start paying off? But while a couple of AI companies have indeed started turning a profit, including perhaps most notably Anthropic, industry-wide data now suggests that users are actually cutting back on spending. So in this video, we're going to take a look at the data and explain why it really does not bode well for the industry. This spring, we visited Greenland to discover the country and find out why it's been such a major geopolitical flashpoint. While we were there, we camped on a glacier, trekked through the wild to find abandoned military installations, and explored the melting oceans, all to answer the question, what's the big deal with Greenland? The documentary is now streaming exclusively to TLDR party members. You can sign up or watch the full trailer by clicking the link in the description. As we see it, the main reason that AI looks extra bubbly at the moment is this graph, which is something called the LLM Token Expenditure Index. To understand what this is measuring, you need to understand what a token is. Basically, when you talk to an AI, it breaks down your instructions into little chunks of text known as tokens, each usually a couple of characters long. Tokens are essentially the basic unit of text that an AI reads and processes, so they're the best way of measuring how much AI you're actually using. The LLM Token Expenditure Index basically measures how much the average user is willing to pay for 1 million tokens worth of AI. Anyway, having essentially doubled between its inception in December and its peak in late May, this index has since fallen by nearly 50%. To be clear, that does not mean that demand for AI and AI-related tools is falling. On the contrary, basically all available evidence suggests that demand is still rising, and pretty quickly. Rather, it means the average price that people are willing to pay for AI is falling. In practice, this basically means that users are becoming more price sensitive and moving towards cheaper models, which are usually a bit less quote-unquote intelligent than the advanced models, but cost less per token. This would be consistent with headlines we've seen recently about various big companies telling their employees to pare back their AI use, and reports that OpenAI is reportedly considering a price cut, apparently in anticipation of a price war with Anthropic. It would also be consistent with other data suggesting that Chinese models, which are generally cheaper, account for an ever larger share of overall token use. More generally, if people are shunning more advanced models in favor of cheaper, more basic models, this implies that a growing fraction of users see AI as essentially a time-saving convenience, rather than some world-altering technology that's going to fundamentally transform their business, which is what the most advanced models claim to be, and what would justify their exorbitant price tags. This heightened price sensitivity and the implied skepticism towards advanced models is obviously pretty terrible news for AI companies, because it suggests that they should expect tighter margins and lower revenues. Now, lower revenues aren't catastrophic in and of themselves, but they can be very problematic when you've taken out loads of debt on the assumption that AI is going to lead to record revenues down the line. This, as you might already know, this is the case for lots of AI companies. While some of the big tech companies were previously able to fund their AI investments with cash on hand, this has now been mostly exhausted, which is why big tech companies are borrowing absurd amounts of money to stay in the fight. Since the beginning of last year, US tech companies have already borrowed more than $300 billion to finance their AI-related investments. This already implies AI spending is ramping up faster than any previous historical episode, including the dot-com and railway booms. And this figure is expected to balloon further in the near future, given big tech companies are forecast to spend between 3 and 5 trillion on AI-related investments by 2030. This year alone, JP Morgan expects US tech companies to issue something like $500 billion in debt, which would account for 20% of all debt issued in US markets. By comparison, in the build-up to the dot-com bubble, tech-related debt peaked at 14% of total issuance. This probably understates things as well, because AI companies have also started relying on a whole load of financial trickery, like special-purpose vehicles, to disguise the true magnitude of their borrowing. But this debt is all premised on the assumption that these AI companies will start to see massive revenues in the relatively near future. According to survey data, investors currently expect these investments to translate into bumper profits as soon as 2028, even while the same companies are supposed to continue spending hundreds of billions on further AI investments. If margins are a lot tighter than people expect, however, and it turns out that, as the LLM Expenditure Index implies, people aren't willing to spend all their cash on the cutting-edge models, then these forecasts could quickly begin to look naively optimistic. And there's already signs that the market is struggling to absorb all this debt. In recent months, AI companies have started issuing more longer-dated bonds, maturing as far out as 2056, which strongly implies that the markets have basically had enough of the shorter-term debt that companies usually issue. But while the markets might have originally appreciated this variation, in the past couple of weeks, these long-dated bonds have sold off and are now trading at steep discounts compared to their short-term equivalents. This all suggests that, while they might be able to make ends meet in the short term, markets are increasingly skeptical of AI companies' longer-term profitability. This might also explain why big tech companies are increasingly leaning on equity to raise additional funds. Alphabet, for instance, have said that they want to raise about $85 billion this year by issuing more stock and hoping that people will buy it. And there was also obviously the SpaceX IPO earlier this year. This strategy also looks like it might be running out of road, however. Alphabet stock fell steeply after that announcement, and after a brief post-IPO boom, SpaceX's stock price has now fallen back down to below its original IPO price, which might explain why both OpenAI and Anthropic have apparently pushed back their own IPOs. Anyway, if even one indebted AI company were to go under, it would probably have ripple effects across the entire sector, because there's a whole lot of circular financing going on here. In other words, AI companies are basically lending money to each other. The way this usually works is that companies who are more focused on the hardware side of AI, like Nvidia, buy stocks in AI labs, who are basically in the business of designing the models, like OpenAI. And in exchange, the AI lab agrees to buy compute from that provider. Ultimately, only time will tell if AI really is a bubble or not. Nonetheless, even if the technology ends up being as transformative as its advocates claim it will be, the industry just doesn't look well placed for the price war that's apparently shaping up. Now, as you're probably aware, it's kind of impossible to avoid talking or thinking about the big players that control our world, much like the ones we've spoken about in today's video. But it's not just the government leaders that impact our day-to-day life, it's also the big companies, and how increasingly difficult it is to avoid their influence. So I bet you're wondering how you can start taking back that control. And luckily, we have a simple solution for you, and it starts with your email. While it might seem insignificant, your email is extremely personal to you, and it's important to keep hold of what's yours. And thankfully, Proton Mail will help you get that control back. It's a private, secure alternative to big companies like Google, and will give you everything you need to be productive, all while keeping those pesky ads away from your inbox. From preventing dangerous phishing attacks with their fish guard protection feature, to protecting your identity by alerting you if your email has been sold on the dark web, Proton Mail has everything you need to stay safe online. They also offer end-to-end zero-access encryption, meaning their emails truly stay private, inaccessible to advertisers, trackers, or even Proton themselves. This means that your email and your information stay safe and secure. No more ads, no tracking, and no profiling, giving you back the control you deserve. Making the switch doesn't have to be a hassle. Proton Mail's Easy Switch tool allows you to move your emails and contacts from your current provider in just a few steps. You can even connect your Gmail account and receive and send messages from it directly in Proton Mail, while you transfer everything over at your own pace. So there's no pressure to switch it all at once. So start using Proton Mail for free today by using our link at proton.me/TLDR, and you'll be one step closer to a fully protected online experience, free from data exploitation.